Wolfspeed dropped 5.3%. Lab scores at 50 out of 100. Hold. Pre-market alerts showed Wolfspeed spiking 13% before the open. That surge triggered algorithmic unwind, dragging the stock 5.3% lower. Stay tuned as the lab tears apart silicon yield curves, wafer scale capacity, and power device backlog driving this volatility and the upcoming EUV litho roadmap. Pre-market alert. Wolf surged 13.7% pre-market, yet its sub 40% wafer yield remains a critical hardware liability. Wolfspeed Incorporated relies on SiC, but manufacturing 200mm wafers is a physical nightmare. High defect density kills yield. While competitor Infineon scales reliably, Wolfspeed struggles with crystal dislocations. These physical cracks halt production. The Mohawk Valley fab operates far below capacity. This physical engineering bottleneck explains why today's pre-market surge faces immediate resistance at the opening bell. Quarterly financials showing modest revenue momentum for Wolfspeed. By Q4 2026, escalating trade tariffs will compress Wolfspeed's automotive revenue growth by 15%. The macroeconomic environment is a crushing wave of friction for this capital-intensive chipmaker. The CHIPS Act provides a $750 million cushion. However, trade policy acts as a barrier. Tariffs on Chinese electric vehicles block access to the fastest-growing automotive market. This geopolitical tension invites retaliatory restrictions on critical materials. Meanwhile, high interest rates of 3.63% increase the cost of capital. This pressure strains their massive manufacturing build-out. A normalizing yield spread signals economic transition. Wolfspeed is caught in the undertow of this global policy shift. Wolfspeed reported earnings per share of negative $3.26, missing the Wall Street estimate of minus 2.06 by 58.6%, a miss that raises questions about near-term guidance. Wolfspeed is trading below its 20-day average, currently at 43.1. Pre-market alert. Wolfspeed's 13.7% surge isn't about SiC, silicon carbide, the wide bandgap semiconductor that handles 3 times the voltage of silicon. It's about the words they stopped saying. Management's headline this quarter: we reorganized into application-focused segments: aerospace, defense, data center. 3 words: diversification, growth, margin. What they want you to feel: relief that EVs are no longer the only story. What they don't want you to remember: last quarter's earnings call opened with record automotive demand, a phrase that vanished this time. That's not evolution. That's retreat. The lab decodes. Insider activity? 0. Not a single executive bought shares in 90 days. EPS, a minus 58.6% miss, the 4th straight quarter of negative surprises. R&D as a percent of revenue? The momentum breakdown for Wolfspeed. RSI sits at 31, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Pre-market alert. Wolf surged 13.7% pre-market as options volume hits a double top. The bull case relies on a $750 million CHIPS Act subsidy and Mohawk Valley's 200mm SiC scale. But here's what breaks the bull thesis. Low manufacturing yields and STMicro electronics expansion threaten to starve Wolfspeed of cash. Our June 9th caution call at $48.78 proved correct, with shares dropping 11.6%. With a neutral AI score of 50, we target $73 if yields improve next quarter, or $43 if bottlenecks persist. Here's the macro picture shaping Wolfspeed. Wolfspeed relies heavily on the U.S. CHIPS and Science Act, which recently pledged $750 million in direct funding to support the expansion of its high-tech silicon carbide manufacturing plants in New York and North Carolina. However, escalating trade tariffs on Chinese electric vehicles limit Wolfspeed's access to the world's fastest-growing automotive market while inviting retaliatory supply chain restrictions on critical raw materials like gallium. The global shift from traditional silicon to silicon carbide chips is like upgrading from cheap plastic to heat-resistant glass, allowing electric vehicles to charge much faster and drive further on a single charge. Yet, Wolfspeed faces intense competition from established giants like STMicro and Infineon, who are rapidly building their own factories and threatening to steal market share before Wolfspeed can fix its production bottlenecks. Over the next 6 months, the biggest boost for the stock would be achieving profitable production yields at their new Mohawk Valley factory, proving they can manufacture these advanced chips reliably at a high volume. Conversely, the greatest danger is that major automotive customers will delay their electric vehicle rollouts, leaving Wolfspeed with expensive, underused factories and a severe cash shortage. Wolf's 12-inch SiC wafer ramp is the only number that matters right now. Wall Street's still pricing it like a niche power play, blind to the 30% ASP uplift hitting Q3. Where do you see Wolf in 30 days? Up, down, or flat? Drop your call. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale. Always run your own numbers. Past performance never guarantees future returns. Hit subscribe. We break down the die-level economics mainstream channels ignore. The lab's out.